My partner in crime was gone on vacation, out visiting family, and he wanted to know where are interest rates going? Why have they not dropped? And when are we going to get a deal? We're going to talk about all the factors going into it. Whether you're a buyer or an investor, you need to watch this. You need to pay attention. You need to learn this data now.
All right, we're going to talk about interest rates.
The question that's on everyone's mind.
Literally everybody's mind. Buyers, sellers, even because they have to move somewhere. Yeah. And then, of course, investors. So, Anton, my first question is, why are rates still high? Did you see that CNBC article? It just went over 7% again.
They totally did.
So tell me, why are interest rates still high?
This is one of those rare opportunities, and this is going to screw with your mind a little bit. High interest rates create opportunities, and changes in interest rates create opportunities. And so this little rise in interest rate is going to create opportunities. And what people don't realize is rates, when they move different than the way we want them to. So they shoot up like a rocket, and then rates float down like a parachute. So as they change, they come down slowly. And as they go up, they just vertical. So we had bad economic data that came out. CPI came out hot. PPI came out hot. Basically, took rate cuts right off the table, and so that caused mortgage rates to float up. What was happening is we believed the Fed has always been talking about 3 interest rate cuts. The market had 6 priced in, had 7 priced in. Today, the market has 4 priced in. So the market backed down massively its expectations. Also, that CPI number, I believe it kind of threw the March rate cut out the window. And everyone wishes and wants for lower rates, but we have to think about this intuitively. As rates decrease, the average buyer, what they qualify for, increases. And the cost of the debt decreases. So for an investor, they want to buy more. So as debt gets cheaper, both buyer and investor activity picks up. Conversely, as debt increases in price, what happens then is that activity slows down.
The reason I'm asking why are rates still high is because we've been waiting forever, right?
We've been waiting forever.
And so naturally, being somebody that wants to buy a house is looking to upgrade the house. I've just been waiting. But I do know as an investor, with higher interest rates, things slow down. So where is the opportunity with these interest rates being so high?
This idea of, once again, you got to kind of fight yourself mentally. These higher interest rates, how they're creating opportunities, we have to think about like buyer's qualifying ability. A 1% change in a buyer's qualifying ability creates a 10% change in purchasing power. So when rates were just, over 7, and then at the end of December here, they dropped to 6.5. That created about 15% more qualifying ability, and you saw everyone rush in. So personally, we sold all of our listings and all of our projects right there at the end of December and right in the beginning of January, unloaded all of our inventory. The market was on fire, and we were taking our unfair advantage because most agents were also then on vacation. And I simply told our guys and our gals, if anyone calls right now during December, they're an A, treat them as an A. And we actually personally did a record December. Best December we've done in 3 years.
And where were interest rates at that time?
6.6.
Okay. Yeah.
Because they came down. So what's happening, and that was here in the Seattle Metro, but that will also happen across the whole U.S. housing market. And so I want to go down just like a little rabbit hole with numbers and data for a second. Mortgage rates were over 7, and then they basically almost hit 8. And then they dropped there at the end of December to 6.6. And now recently here in February, they're starting to crest over 7 because of that negative data. Here's how you can really pay attention to what's happening inside of the market. So this is for our uber nerds who genuinely care about data. I'm going to tell you the data and how you can go through it. And I know who you are, and you are just like me. So please go look at this stuff. So this is mortgage applications by week, according to the Mortgage Bankers Association. And when you look at this graph right here, you go, okay, what is this really telling me? You have to think about what was happening. So look at the graph right under there where it says mortgage rates by week. Now, that's a conglomerate of all mortgage rates. So you can see in the beginning of December, they were 7
mortgage applications.
Well, no, we're going to rates first.
Oh, got it.
So they were 7.17. So look at the bottom graph. See how it's really high. Now see, as interest rates drop towards the 17th of December, what then happens as rates drop on the lower graph, so as rates trend down on that lower graph, you can then see applications go from minus 10.7% to an increase of 9.9 and an increase of 10.4. So the end of December and the beginning of January just exploded in mortgage applications. We personally felt this inside of our business. Then rates bounced up a little bit, and then they started trending back up. And then all of a sudden, last week in February, you can see mortgage applications again, as rates crested 7%, were down 10.6%. So what happens is the media comes out and they go, the sky is falling, because it's a big number. And they go, interest rates are down, or excuse me, mortgage applications are down 10.6%. And what I want you to do as a buyer and you to do as an investor is that is your cue. This is the pill inside of the matrix. You've taken the pill. The rest of the sheep are going, it's a bad time to buy a home because rates are up and applications are down, but you have to flip it around. That means less bidding wars. That means more opportunity to get closing costs paid for. It means more inspection timelines. It means maybe zero offers on that property. As an investor, it means you may be able to buy something at a deep enough discount in order to deal with that higher interest rate or get a higher cap rate. What's super awesome about this is then they also take this exact same data, okay? So this is data from the Mortgage Bankers Association, and they call this the purchase index. And what they do is they take this data and then they just graph it over time. So the purchase index includes all mortgage applications for the purchase of a single family home. It covers the entire market, both conventional and government loans and all loan products. The purchase index, and this is what I want you to understand, listeners, subscribe if you haven't, because these are the things you need to understand. The purchase index has proven to be a reliable indicator of pending home sales. So the purchase index shows you where homes are going. Because what happens is there's a couple factors that are on the bleeding edge of this. Altos Research, one factor they show it, and I believe they call it something like newly left inventory, and it's inventory that leaves the market in less than 4 days. It's a statistic they track. So it shows you homes that are being picked up across the whole U.S. quickly. This shows you applications for those mortgages. So as this number rises, you know the market is heating up nationally. As this number goes down, you know the market is slowing down. So back to opportunity. What this means is as rates rise for the average buyer, they can afford less, competition drops, and this can be seen right in this application data. And when you see this go up, once again, your spidey sense should be going off and going, great, it's a better time to buy. Here's what happens instead. The average home buyer looks around, the average investor looks around, and they go, oh, the sun is out. Oh, I feel warm. I feel emotional. I should go buy something. They don't look at like there might be market cycles and things they can properly time in order to get the best deal. Instead, they buy sheer on emotion.
Okay, well, I don't want to buy on emotion, but my next question is this. This is totally emotional. I've been waiting for rates to come down. And the next question is, should I be waiting for rates? When do you think rates will come down? I feel like this is kind of like going to go a certain direction.
Yeah.
But I guess, we thought rates. On top of it, just to give even more context or kind of where my concern is, typically when interest rates are high, home prices go down, but they haven't gone down as interest rates go up. So what do we do right now? Like, do we wait for rates to come down, and when will rates change?
This is an example of recency bias. And what happens, and all of us are guilty of this. Hi, my name is Anton. I am 1,000% guilty of what we're talking about. And my wife goes, you're wishing for everything to be cheap because you missed 2008. And we all want 2008 or the great financial crisis to come back again because everyone says, I should have bought a home. But the difference is between day and 2008 is no one was prepared in 2008, 9, 10, 11, and 12. No one had money. There was 18 months worth of inventory Unemployment was literally at an all-time high. The only other time it had been higher was the Great Depression. When people say, I really want rates to come down, I want everything to become more affordable, that's what we're wishing for. This is one of those cases where I have to say this time is different, and I hate saying that, but this time is different. And the reason it's so different this time is a few major factors. One, from 2008 to 2012 nationally, home builders stopped building because they couldn't finance product. Now, they didn't stop completely, but they dropped by, in some areas, as much as 90% of new construction. So it went from a peak in 2000, depending on where you were in the country, 5, 6, or 7, to as low as some places was, only a 30% drop, and some places dropped 90%. The Seattle Metro here, new construction vanished. It was a ghost town. So we have 4 years where new construction wasn't built, and we have not caught back up on that supply. The other thing that happened is the Fed broke housing. The Fed broke housing by creating artificially low interest rates. And we refer to this as the ZERP era. So I wanted to dig into this because I want people to understand the ZERP era.
Never heard that before.
ZERP is referred to as the zero interest rate policy. It is a macroeconomic concept describing conditions with a very low nominal interest rate. Specifically, our Federal Reserve took us to zero. These conditions have been seen in contemporary Japan and in the United States. In the United States, we did it from 2008 to 2015, and then again during COVID from March 2020 till March of 2022 as a result of the pandemic. This is considered to be an unconventional monetary policy. Why? If you're at zero, you can't cut any lower. When rates are at zero, what it does is it forces people to not save because there's no incentive to save, and it flushes money into the system. They did ZERP, and they printed $9 trillion, well, $13.5 trillion total if you count all the bills. But there's still approximately anywhere between $6 trillion to $9 trillion sloshing around in the U.S. economy. So we joked before, and we called them drunken sailors. They're still drunk. The economy is still drunk. This is why prices didn't change, because there's still so much cash out there. And then fundamentally, the U.S. is approximately 3 to 4 million units behind on housing.
So low inventory.
Low inventory. Low inventory is here to stay. I want prices to go down. I want the low interest rates. I want my 2008 all over again because I'm in a better financial position. The problem is so is rest of the country. So our recency bias, this cognitive thing that happens to us, is telling us we want this to happen, but it's not there in the numbers. Now, the other part of this, in addition to the Fed breaking housing, is the fact that we've all now created interest rate hostages too. And we've talked about this before, but it's always worth bringing up. Go to a baby boomer and say, hey, I'd like you to trade in your 3% debt, if they even have a mortgage, because over half of them don't have one. And I'd like you to go get debt at 7.1% today. What are they going to say?
No chance.
Not a chance. Now, what they will do is they may keep that as a rental and go buy another one, but there's no chance they're letting go of that. The dialogues that my real estate sales team has had with home sellers over the last 6 months, 9 months, a year, when someone talks about selling their home with a 3% interest rate, it sounds like I'm asking to steal their firstborn child. They're emotionally wounded. They can't let go of it. It's this huge fear of loss, because what's happened, unlike 2008, when the mortgage was a toxic asset because of the arms and no one could afford them. Today, people can afford them, they qualify, and the debt is an asset today, so no one wants to let go of it.
Well, there's a reason. It's not just emotional, it's just logical. If you bought anywhere before, let's just call it 2018, right?
Yeah.
Even when interest rates were going up before they went back down to zero in 2020, the difference in the home price is not only up, but with the interest rates also going up, you're probably doing triple the mortgage payment. So it's a financial no, I can't even afford it. So I know for my personal situation, I've been in my house now for 12 years.
Yep.
The average used to be, I don't know what it was historically, but during that historically, okay, 6 years. Anton's holding up 6 fingers, so I didn't come up with that. 6 years during that crazy time between 2002 and 2007, it probably really shortened.
Yes.
Right, like maybe 3 to 5 years.
Yep.
And then probably actually stayed pretty short as interest rates went down.
Yep.
So there's a lot of churn. But now we're going to a point, I don't know what it is, but I have a feeling I would bet money the average is above 6.
It's way above 6.
And what do you know what it is?
I totally know what it is.
Yeah.
Because
What
we're
is
going to
it?
go there.
Okay.
It's a decade. It's
Yeah.
10 years. It's actually slightly above 10 years right now. So this lock-in effect and this lack of affordability is keeping them stuck there. You also asked, like, when are rates going to go down? Tell me, Anton, I want to know. No one knows. If you know, you can pick winning lotto numbers. But we can make bets, okay? And we can make educated bets. So here's an educated bet. The educated bet is that we will be in the mid to low 6s later this year as the Fed drops rates, because we know they're going to drop them. They've said they're going to drop them. The Fed has said 3 rate cuts. So we know that interest rates will come down anywhere between 0.75 to 1 whole percentage point from where they're at today, because the Fed told you they were going to do it. As they start cutting rates, what we've talked about on previous episodes is that mortgage margin will also collapse. And if that mortgage margin collapses, that could add an additional 1/4 point to a full point to that number. Now, don't go being moon boys and moon girls on me. I still believe low 6s end of 2024. In 2025, I do believe we could get into the 5s. And if we're lucky in 2025, you might maybe, or maybe 26, get into the upper 4s. And I believe long-term, we're going to settle in that 5.5 to 4.5 range.
So already know what I'm already doing mentally and what anybody that has been waiting for interest rates. We're going to wait for 2024 and 2025. So then the next question is it smart to wait for those lower interest rates because mortgage payments are so crazy high?
Yeah.
So that, what we're talking right now, it's at 7. It just hit over 7 again. If it could potentially and realistically go to even 5, that's like what? 22, 23% less,
Yes.
maybe 25. I don't know what the math is on that, but that's significant,
Huge.
right? But I guess the scary thing is, what if house prices don't drop, they stay or even go up? It might not make sense.
That's where we're going.
Yeah.
So think about it like this. Everyone's always looking for the perfect combination. And so they want to wait until the perfect combination of events show up. Never wait to buy real estate. You buy real estate and then you wait. Time makes you look like a genius. There are investments we purchased in 2007, right before the crash, as the market peaked. A decade later, I looked like a genius in 2017 when I sold them. And I never should have bought them. And I bought them on 0 down, interest-only investor loans. And they were literally those horrible ninja loans with the negative AM, even if you wanted it, and things like that. I was an idiot for buying it. Time made me look smart. So this isn't wait to buy, it's buy and wait, number 1. Number 2, if you're waiting, Benji, and rates come down, who else is waiting?
A lot of other people, a lot of competition.
You're nailing it. Every 1% change in interest rate allows a buyer to qualify for 10% more. So it's not just you, it's every buyer, it's every investor. As the rates come down, they go, I want to buy more. What's happening, not just in the Seattle metro, but across the whole United States right now? Are prices going up, down, or sideways?
I think they're sideways, if not going slightly up.
They're going up, and they're going up faster than anyone thought. Everyone, Fannie Mae, Freddie Mac, Mortgage Bankers Association, Goldman Sachs, all of these analysts all revised their housing predictions for this year up. Why? Because January numbers came out, they had that new set of data. And everyone's housing predictions are now for the U.S. market to appreciate between 2 to 5%. The Seattle metro, I went and looked at this. We already did the numbers. You can go watch the video. 6.6% on average is up throughout the metro when I compare January versus January. So when they say, oh, I want to wait. Well, let's talk about a $700,000 house here in Seattle. That $700,000 house by the end of this appreciation cycle is going to be a $742,000 house. And then the thing to be thinking about is these appreciation cycles generally happen until the end of the spring market, which is usually sometime around June. So all the appreciation happens in the first part of the year as the sun comes out, as we move out of winter. Emotionally, humans, we come out of our cocoon and we look around and go, man, I feel good. I should go buy some real estate. Everyone feels that way. So this idea of waiting is just going to negatively impact you as an investor and negatively impact you as a home buyer because we're not building enough housing units.
Because the difference is we're waiting because in 2008, it would have been smart to wait for a 2010 or 2012.
Yes.
But the circumstances are totally different.
The circumstances are totally different because we built the most new construction ever in the United States, 2003, 4, 5, and 6. Ever. Then it crashed, okay? Because builders and developers could finance at 100% of value, and we know it takes 25 to 35% total cash into a project now to be a builder or a developer. Period, end of discussion.
Oversupply.
So there was an oversupply because it was easy to build, and we had the ninja loans. Today, everyone has to qualify, and builders have to have cash. But wait, it gets worse. It sounds like a rap song. It is. During that same time period, what happened is we started over-regulating red tape, land development, new construction, especially here in the liberal coastal states that we live in. That new construction land development has just slowed down and exacerbated the issue and also exacerbated the price increases. There's a whole episode where David Toyer talks about why land development is so expensive that people can go check out if you want a deep dive into this. So we have a housing supply problem because of the lock-in, because the Fed broke housing. We have a housing creation problem because of the how hard it is and the red tape to go build or develop something. We have a cash problem because it now requires more funds to be able to do it. So if nothing fundamentally changes, and I believe politicians can't do this because government does nothing but get bigger. So if nothing fundamentally changes, what's going to happen is we're going to have more renters, less supply, and more expensive housing everywhere in the U.S. And then it's over-exasperated in coastal areas and high-density metros like where we live in Seattle.
Okay, so if that's the case, you're saying look like a genius, buy right now, no matter the rates, and then wait for the interest rates to potentially drop. But we're in a circumstance where interest rates are high, so it's going to be very unaffordable. If rates aren't going to change, what's your advice for dealing with that higher interest rate for buyers and investors and even sellers who might ultimately need to buy?
No, I love it. What we're going to talk about next, so there's multiple ways to deal with high interest rates. Some of them are okay. Most of these are problematic, and some of these are going to make you sick to your stomach. What the consumer is looking for is this magic pill to make housing affordable. It doesn't exist. The only thing the consumer can do is they can get involved in local politics and do things that promote housing in their area. That's the best thing you can do. So, number one, you could always pay for points to buy down the interest rate. You reach into your pocket, you pay points. Points is like a 0.5 percentage point of the purchase price, 1%, but it's always going to be between 0.5% to 3% of the purchase price, and that's going to lower the interest rate by, and it depends on income, credit, all these different things, by 0.5% to 1%, but it's very expensive, okay? 2, you could get the seller to buy down the rate. If the market hits an inflection point, because rates just shot up a little bit and buyer activity went down a little bit, do you think as an investor or a home buyer, you might get a seller to be able to kick in some rate buy downs during a market transition?
More leverage, yes.
Bingo. Okay, now we're going to get into the stuff that you may not want to do. You can save and create a larger down payment. Yes, that's right. Savings works. Save more money, put more down. The problem is in areas like where we live, you won't outsave the rate of appreciation unless you have a phenomenal way of doing that. Cool. Let's go borrow some money from someone. You know what? You need to pick up the phone and call dear Aunt Tilly
Dear Aunt Tilly.
and say, dear Aunt Tilly. Dear Aunt Tilly is a made up fictional person. There's no one in my life named dear Aunt Tilly.
Do people ask about that
Yes.
in the comments?
I've gotten DMs. Who's dear Aunt Tilly? Like, how do I find my dear Aunt Tilly? This is someone in your life that you could go ask for money who would give you the money. And yes, once again, some of these aren't comfortable. You may have to sell some of your stocks. You may have to dig into your IRA, your 401k, your retirement account. You might have to sell a toy. You might have to sell a car. Now, I'm going to be honest with this one. Your car payment is preventing you from purchasing the home of your dreams. This is true for like 60% of Americans. They have outlandish car payments. You do not need that $1,000 car payment. Go sell it, get a $300 car payment, and go buy a nicer house. This one's really creative. Uncle Sam does not care whether he holds the money or he gives you the money for your tax break for owning a home. So Uncle Sam only cares about two people, businesses and homeowners. Everyone else they want to take money from. What they do is they reward homeownership with an interest deduction. So as you pay interest on your mortgage, you get to write that off your taxes. At the end of the year, you get it back tax-free. But Uncle Sam pays you zero on your money. So Uncle Sam also doesn't care if you just claimed less in taxes. See, if the deduction's going to happen anyway, you can go to your HR, you could change your deductions, and you could get an increase in your income today. So let's just do some quick rough.
What's HR, by the way?
You're the human resource department.
Okay, got it, yeah.
Yeah, no, we don't have real jobs. I get it.
This is HR, and this is in relationship to your W-2 income.
W-2
and
income.
how much they take out of your paycheck.
Bingo.
Yeah,
So
that's creative.
So let's give them a real example. Let's say their mortgage payment is $2,600, and out of that, $1,900 a month is interest, and the rest is taxes, insurance, and principal. So you literally take the $1,900 times 12. So at the end of the year, Uncle Sam's going to allow you to write off your taxes, $22,800. And if you're in, let's just say you're in a 27% tax bracket, so times that number by 0.27, they're going to give you back $6,156 on your tax return, which is nice. Well, you could simply divide that by 12, which is $513 a month, go to HR, change your deductions, have them take $513 less a month out of your paycheck, and just pay the higher mortgage payment. Because Uncle Sam's not going to give you any money for it. Now, if you want to really do this, there's not financial advice. Go talk to your accountant. Your accountant can help you figure out the exact number, and you can make it happen. Now, all of these are going to just get more painful, so you have to bear with me. You could get rid of mortgage insurance. So in order to get rid of mortgage insurance, you have to put 20% down, or there's got to be 20% equity in the property. Listener, if you've lived in your home more than the last 3 years, you probably have 20% equity. And if you have mortgage insurance, I just spoke with one of our clients about this 2 weeks ago. I wanted to tell you this, so I wrote it in here mentally as the story. Her mortgage insurance is $513 a month. She's lived in her home here in the Seattle Metro for not quite 3 years. So I did a quick CMA, and very easily, she's at 70% of value. So she submitted my CMA to her bank and said, please remove my mortgage insurance. Let me know what else I need to do. They sent her back the documentation, said, we're looking into it. We're going to run an automated valuation. And if all that works, we'll remove the mortgage insurance. And she's going to save over $500 a month.
Whoa.
That's a hack if you already own it. The other thing you can do is you could extend the term of the mortgage. So instead of getting a 15-year or a 20-year, amortize it over 30. We're not quite here in the U.S. ready for the 40-year mortgage, but it's coming. The 40-year mortgage is coming to help with affordability.
By the way, on that note, in a place like Japan, where real estate did this crazy thing in the 70s and 80s, like skyrocketed, I've heard 40 and 50-year mortgages, multi-generational mortgages, because they had to deal with it too. And I don't know this, I don't want to get off on a rabbit trail, but you know what happened over there?
No.
House prices just went like this for decades.
Just kind of flat.
I just got back from Japan. I was, of course, looking at real estate. I'm like, let's just see what the market is like here. Yeah. Right now, it's more affordable to live in Tokyo than it is here. Because their house prices, because it got so crazy, and they went through that low interest rates you talked about earlier. Yep. They had these 40, 50-year mortgages. Boom. And the reason I bring that up is I'm curious, like, what if we never go back to this, but we also never go back to this, meaning it never drops down, it doesn't go up. We go into this. I talked about this a year ago.
Yeah, just flat.
Just flat.
Yeah.
So then on that note, it would make sense to buy right now.
It would totally make sense and to buy right now. And even if it goes flat, flat is good. The problem is it can't go flat because we're below a month worth of inventory here in the Seattle metro. There's too many people.
Well, yeah, in Tokyo specifically, they had to go to apartment buildings and condos. They don't have,
So another way to lower it, shop your mortgage insurance. Go shop your homeowner's insurance and make sure you're getting the lowest rate. When your property tax bill shows up, so this is for people who already own the home, go appeal your property taxes. I may or may not have just won multiple appeals and saved probably grand total $48,000 in taxes in 2024 by appealing all of those tax statements that came in.
Think about the logical reason why this is totally doable. As house prices are coming up, they jack up the taxes because they want the revenue. As house prices come down, they don't lower them very fast because they want the revenue. So you appealing, though it kind of seems like, oh, how would I get that done? It actually can get done. And yes. I think secretly they don't want people to know it can be done, right? But if you can make the case, what you're saying is they have to kind of look at it objectively.
Well,
right?
And it's a hassle. So it took me, and this is what I do for a living, it took me 2 full days to submit 9 appeals. But I knew instantly by looking at them, they were completely wrong. Like in one example, it was tax assessed for $2.5 million when it was worth like 700, maybe 800 grand. I got that one reduced to 777,000. Next, there are expenses in your life that you can cut. Most often what we see is those subscriptions because you have Hulu, you have Netflix, you have Paramount, you have Peacock, you have Spotify, you have Pandora, you have YouTube. Like there is a few that you can cut so you can afford a better house.
You probably just saved me $100. Thank you.
For those of you that have a loan, people don't realize this, but there's a process that most mortgages have built into it. It's called recasting. You pick up the phone, you call the servicer, and you say, I'd like to recast my loan. And what they do is they will kick it back out over the original term at today's interest rate with a significant down payment. So if you've paid on the home for 3 years, because they don't want to lose you to a refinance, they're like, oh, you know what, Benji, if you put 50 grand down right now, 20 grand, 100, whatever the number is, they'll recast it back over the 30 years. They shove it against the principal and your payment goes down. Most loans will only allow 1, max 2 recastings ever. These last ones are the real painful ones. You could get a roommate. You could literally go get a roommate to help pay for that mortgage. You could go rent out a room on Airbnb.
Or maybe have a garage that could become a mother-in-law.
Bingo. You know, put a little RV pad in next to the house. Also, you could increase your income. If you increase your income, that housing expense won't be so much. Once again, I apologize. I know all of these were not as fun as people wanted them to be.
Well, then I guess let's move on to the next question. Baby boomers to blame for housing shortage? Real estate report says. Tell me about this. Is it true?
This was sent to me by a listener, and this is an awesome title, and I'm jealous because I didn't write it. It's very clickbait, and it has like a nugget of truth in it. It also has a demographic that we can hand to and be like, oh, you're the scapegoat. So basically it said, hey, Americans are staying in their home longer. We talked about how that's happening, how the average amount of years that a homeowner's spending in the home has been increasing. So in the U.S., the average now is 12 years in a home. That's up from 6.5 years 2 decades ago. Redfin found that 40% of baby boomers have lived in their home for at least 20 years. And more than half, 54% of them, own it free and clear. So this article says, you know what? We're just going to blame the housing shortage on baby boomers. We know what the housing shortage is from. The housing shortage is specifically from the great financial crisis. We didn't build houses during the great financial crisis. And we built some, but the amount of new construction went down significantly. It now requires more cash to build, 25 to 35% more to build a home or do a land development project. And we know that regulation and red tape basically doubled during that, creating longer time frames and more expenses. What this means, though, is we have baby boomers that are now aging in place and staying there so much longer because it's the most affordable thing. They found out that a lot of these baby boomers who have their home paid off can live in their home for $600 a month, which is the property taxes, the insurance that doesn't include the utility bills and things like that. But there's nowhere they could go rent to replace that. And if they were to move into a retirement home, we know, of course, that's going to be thousands of dollars or tens of thousands of dollars. So what happened in 2023 was existing home sales dropped to 4.9 million, which was the lowest, 4.09 million, which was the lowest level since 1995. While the median price in the United States hit a record high of $389,000. And of course, here in the Seattle Metro, our median price is like $765,000. So ours is double what it is there. So you got these baby boomers who are staying longer, who normally would move just like everyone else. You have millennials who are getting into their first homes. You got Gen Z sneaking up behind them, trying to get into their homes. And what you have is just this sheer lack of supply. People are looking for people to blame. So this article is incorrect. If you want to blame anyone, you need to blame your local politicians for making it too hard to build and develop and too costly. And you need to blame the Federal Reserve for lowering interest rates during ZERP to zero and holding them there too long, both from 2008 to 2015 and during COVID. That's what created this problem. That irrational exuberance when money was too cheap, people were able to gobble up too much. So you not only do some of these people own their home free and clear, they own more than one. And so they have a second home that's basically just a vacation home, which then prevents the next generation from being able to access that housing. Nothing's going to change this. This is just a great clickbaity title.
Yeah. I mean, my biggest takeaway from everything you said, which was a kind of a masterclass in interest rate forecasting, which is impossible. That's a simple answer, is it makes sense to buy when you need to buy or want to buy, but at the same time, don't be in a rush necessarily because we still have some like headwinds like right now, you know? Because, you know, it's interesting. I just got back to the podcast because I was away for about a month, and I distinctly remember about 4 to about 6 weeks ago, we were kind of forecasting 5% interest rate this year.
Yes.
And that's already changed.
Yes.
I mean, you've never been saying like, hey, I'm like got all the answers. I know exactly what's going to happen. But it's interesting just even with you looking at the data and of course, along with what experts out there are saying, that's saying, so you just never know what's going to happen. But I think the other thing too, I don't know if this goes on a complete rabbit hole, but one of my big takeaways from this had nothing to do with the interest rates, but it's something that you kind of talked about, especially with baby boomers, but even me. I've been in my house since 2012. When I look at my mortgage statement, you know, the thing that excites me the most is not just the interest rate I locked in back in 2012, right? But also how much I've been paying my house down.
Yeah, the principal reduction.
So over time. And so the reason I bring that up is if it's free and clear, you're already like able to buy a second house, become a rental because you have a lot of equity, okay? Even at these higher mortgage rates. So that whole like blaming the boomers, there is some truth to it because if they paid that off back in 2010 or whatever, or they got lower interest rate, you know what I'm saying? But for me, I'm already thinking like I've got this much equity as long as you don't get a second or whatever. So you could almost create a timing based off of when the last 0 to 1 to 2% interest rates were. Well, we just had that a couple years ago,
Yep.
so it's kind of reset it. But 8 years from now, and just again, entertain me here.
Yeah.
8 years from now, you could be having a whole group of people that are feeling my way and that have the equity, right? If they just stay put, and you just named it, 10 years, right?
Yes.
They're staying in it for 10 years. It kind of correlates with my 10 years. But then what about all the people that bought pre-2010 or pre-2000? Their event's going to be in free and clear on top of the baby boomers, right? I don't want to get all morbid, but of course there's going to be some people passing. So it's interesting to think about that because like you said, I think the whole big takeaway point of this is it's not just interest rates. There's other variables. And that is a variable that you don't think about when you're buying, because if you buy right now, 10 years passes way faster versus buying 10 years from now. And then you're starting the clock over.
So this whole episode, we kind of went through and said it's not happening. I want to give people the light at the end of the tunnel because there is this glimmer of hope that it's happening. If you want to read about this, all you have to do is start going and Googling China and their property developers. And what you'll see is that those property developers, Evergrande going under, and I forget the names of the other ones, them going under, and the fact that China, about 26% of their whole economy is based on real estate, which is about double what we are here. And so what did China do while you were gone? China turned on the money printer to start saving their real estate. So the second largest economy in the world said, wait a second, this is becoming a black hole, a problem, the swan. And the thing is this one's not a black swan. This is a known event. This is more like the Titanic. It's iceberg dead ahead. They can see it coming, and they're like, oh, crap. So they're turning on the money printers because they're starting to see prices actually drop. They're seeing actual deflation. And so they're starting that. Well, does that mean that the U.S. might have to cut more, faster, more rapidly because of that economy? And the answer is maybe. Can we make any bets on it? Don't know. That's something to really watch, though, because that could force the Fed's hand quicker than they want. So then what the Fed is going to murmur about is this thing called, what do they call it? They call it something like FATE. And it's flexible average inflation rate targeting or something like that. And the idea is they've said that 2% is the goal. But they have this other policy over here. And once again, I believe it's called something like FATE. And what it does, that flexible average interest rate target says, well, we can just take the average. And Benji, did they define what time period they could take the average over?
No.
They didn't define the time period. They didn't define how the data. So the Fed can literally just say at any second, oh, let's average it over 10 years. Boom, you're below 2%. Or you're at 2%. Oh, boom, let's average it over 5. Boom, interest. And then they can cut. So they're going to use this in the back. And this is why this stuff's so hard to predict. And this is why I don't want an investor to wait. I don't want a buyer to wait. If they're thinking about doing it and they can financially afford it and they're not going to be dumb and it's a good purchase for their family, or it's a great investment that makes sense in today's market. See, a good investment, if it makes sense in today's market, will be a great investment here in the future. We don't know if they're going to do it, but there's signals. There's light at the end of the tunnel that this is possibly happening. And so I want to close with one last thing. Investors have to look at high rates from a different perspective than a buyer. So as rates rose, what happened to cap rates?
They went down?
Cap rates went up.
Oh, went up. Okay, yeah.
So cap rates went up to compensate for the higher cost of the debt. In other words, people wanted a higher yield or a better return because debt was more expensive. So one, we know cap rates have risen. Two, this has caused commercial values, depending on the sector and the area, to go down between 10 to 15%. And in some cases, some harder hit areas or harder hit sectors as much as 25. So we know the Fed again, because we've talked about this. We've got the receipts. We've got the videos. Banking crisis 2.0 is headed our way if the Fed doesn't fix commercial real estate. So right now, what that means is if you have the capital and you can mitigate some risk, it's time to make some bets.
Because interest rates very likely could go down.
Bingo!
You refinance.
Oh, it's so beautiful. So if you can get a good deal today and interest rates go down over the next 24 months, you probably just created 15 to 30% in equity.
And before competition gets crazy.
Because what the bank is going to do is they're going to put you through the freaking ringer. So we told you this was coming. We shouted it from the rooftops, and none of my friends and fellow investors wanted to listen to me. And I'm getting all of these calls in the last month. Lending criteria is freaking tight. One of our friends who has a phenomenal track record is building a townhome project. And this townhome project should have came out at 75% loan to cost. That's the normal rate. The bank said, we don't really feel comfortable right now. We'll give you 55. That means they had to put $1.4 million more in cash into the deal in order to make it happen. This is an A credit, medium-sized investor, lots of units. When I say medium's a lot bigger than what people think. We're talking in the 50 to 100 unit category. Who has done this before, who is doing it again, who's now being pinched. So banks are pinching everyone right now. Why? Because bank margins have gotten so tight because the amount of interest they have to pay on savings, on CDs, and because all that capital fled out into treasuries and money markets. So as the Fed lowers interest rates and they come out of CDs, because there's like $6 trillion in that right now, and usually there's like 1.8. So $3.5 to $4 trillion will come out of CDs and bonds and go right back into savings accounts and things like that, which will prop these banks back up. So once again, we got these little glimmers of hope that rates are going to come down, but we can't bet on it. And I can tell you that as rates come down, the price of real estate, especially here in the Seattle Metro, is going to go up.
Boom. Well, then you guys subscribe for more dope real estate information like that. And put in the comments, what's the interest rate going to be? What's your forecast for end of 2025?
Yeah, let's take bets. Let's go.